And Friday, May 12th was my birthday eve. MBS were down 33 basis points. Stocks were flat in the morning. Bonds drifted into modestly weaker territory overnight, with most of the movement seen in the European trading session. Bonds entered the domestic session in moderately weaker territory, but erased most of the gains after the 8:30 a.m. economic data, though not necessarily because of it, because most of the rally happened around 9 a.m. Eastern time. Import prices came in up 0.4% on a 0.3 forecast. It was negative 0.6 previously. Export prices were up 0.2% on a 0.2 forecast. They were down 0.3% previously. Bonds then lost some ground after the consumer sentiment data showed a 0.2% uptick in 5-year inflation expectations and no meaningful movement in the 1-year expectations. Consumer expectations fell 11% despite a strong labor market. Inflationary expectations for the near term fell, while longer-term expectations rose to 3.2%, the highest level in 12 years. We know the Fed pays close attention to the UDM inflation expectations, so this is bad news for those hoping for rate cuts this year. Overall, consumer sentiment is down 9.1% from April. We also got the Fed Governor Michelle Bowman, who spoke in Germany this morning. Her comments were pretty hawkish on monetary policy, and nothing remotely suggesting rate cuts coming in the near future, though the Fed future see it being imminent. So there's a lot of people that actually make this decision saying it's not coming, but the market is betting otherwise. Yesterday's bounce at 3.35 suggested that the bond market's will to rally may have been running out of steam. It was far from a guarantee, considering bonds nonetheless ended the day on lower yields, but a vague potential warning perhaps. Today's early trading suggested the market hadn't made up its mind before the 10 a.m. economic data. After the data, however, the range received clear reinforcement from the higher inflation expectation component in the consumer sentiment numbers. At the end of the day, MBS were down 37 basis points. Stocks were down 7 points, ending up at 100.61 on the treasuries, is putting us right in the thick of 4 lines. So we have a convergence of the 200-day moving average, 100-day moving average, a Fibonacci, and the 50-day moving average. So they're all kind of converging upon each other right where we're at now. So if it can break to the upside, we have a little bit of room to run up to 101.34. If it breaks to the downside, we don't have another floor until 99.845. Also got some other news prior to the Silicon Valley Bank failure. Interest rates on bonds issued by money center banks like JP Morgan were about 15 basis points lower than for bonds issued by large regional banks like Huntington Bancshares and M&T Bank. That gap since has widened substantially and is now about 135 basis points. So that makes the lending for these mid-sized regional banks over a point more expensive. This gap exists because investors fear the government might let the regional fail, and because of the possibility of added regulatory burden. That came from econ70.com. We did get a post from our sponsor at wellthatmakesense.com. It's all about do the thing and you shall have the power. So this is all about doing those hard little things that make slight improvements in your life, in your production, in your happiness every single day. But it's all about the small changes, doing them repeatedly versus making giant seismic changes. Looking into it next week, not a lot of data. The big movers will be on Tuesday when we get retail sales, and then 20-year bond auction on Wednesday. If you have some time this weekend, definitely check out our common sources and influences, particularly our sponsor at wellthatmakesense.com. Have a great weekend, everybody.